estimate buybacks could add another €15 per share of value.
David Einhorn is a billionaire hedge fund manager with an estimated $2 billion of assets under management. Now, this is a really interesting guy. He is a classic value investor, but also a contrarian. And in this video, I'm going to dive into a recent boring stock which he has been loading up on, and he's provided a huge amount of information. So that being said, if you're new around here, I'm Ben. Welcome to Motivation to Invest. We cover stock analysis, AI, and tech on this channel. If that's of interest to you, feel free to subscribe to the channel, join the community. If you find any value in this video whatsoever, feel free to give it a big thumbs up and comment your thoughts below. That being said, let's get right into it. David Einhorn is a classic contrarian. At the moment, everybody is talking about crypto. They're talking about US stocks, which are booming. Einhorn has taken a different perspective.
The last 2 years, I've given presentations on European companies that most of you had never heard of. Maybe it's because we're finding more value in unloved European companies. But this year, I will present you another European company that most of you have never heard of. We're on a streak. Last year, I presented Solvay, which has since returned 25%, including dividends. 2 years ago, I presented Vitesco, which went up about 50% in the next 6 months.
So in his words, in a recent interview, we're seeing the potential for significant upside in European industrials. Many of these businesses remain cyclically depressed due to war-related disruptions and past energy shocks. A peace settlement, he argued, would trigger a lot of rebuilding and opportunities for European companies. So a previous stock I covered on this channel was Solvay, a soda ash producer. Again, these are what's called boring stocks, but boring stocks are often overlooked by the market and often mispriced. And this is why David Einhorn really does cover these type of stocks. So let's dive into the one today. The company is called Lanxess, and it's a German-based chemical company. Again, a boring industry nobody really cares about. But by us caring about it on this channel, there is potential for significant uplift. So spoiler alert, this stock could potentially 2 to 3x based on its valuation. And let's dive into the reasons why.
The cartoon says, what are you going to be when you grow up, a butterfly or a moth? Transforming a business is no easy task, and Lanxess has now done all the heavy lifting of repositioning its portfolio of businesses. Lanxess owns a strong portfolio with reduced complexity, lower asset intensity, and is now focused on cash generation. We think we are left with a butterfly, which is being perceived for the moment as a moth. The quality of Lanxess has improved, but its value has not been unlocked yet. Let's observe what Lanxess looks like today. Lanxess is organized into 3 segments. The first segment is consumer protection, which has 4 separate business units. All the business units are top 3 players in niche markets. Like me, you probably have no idea what biocides are. They are products intended to destroy or control harmful organisms to protect us, animals, and materials from harm. Think of items like disinfectants, preservatives, pesticides, and antimicrobials. While Saltigo doesn't immediately strike you as a consumer protection business, most of its unit focuses on crop protection chemicals.
Okay, so sales have been roughly flat year over year with $1.6 billion in Q1 2025 and also similar in Q1 2024. However, the EBITDA profit margin is where we've seen a significant uplift. That has jumped from 6.3% to 8.3%. driving from 101 million euros to 133 million euros, up 32%. So this is significant. Now, the key driver of this has been margin improvement across all its segments and higher utilization and restructuring efforts. Now, we see this across its consumer protection segment with strong EBITDA increases. Now, this has jumped from 9.6%, 49 million euros, to 73 million euros, 14.2%, up 49%. So we can clearly see that the profits and margins of this company in this segment and overall are increasing drastically. Now, in the specialty additive section, we see a similar story, slightly less amazing, but still a slight uplift. Margin increase 8.5% to 9.5%, 48 million euros to 52 million euros, up 8%.
Additives has three business units, which are all top three players in their markets. Polymer Additives business unit operates a bromine well in Arkansas, which has a 70-year reserve and is vertically integrated for the whole bromide value chain, which is mostly used in fire retardants. Rhein Chemie is a world's largest rubber additives manufacturer.
Now this chart shows everything fantastically, so you can see the 32% uplift in EBITDA, which is the earnings before interest, taxes, depreciation, and amortization. Up, 32%. This segment, 49%, which is the main driver. Second segment, up 8%, and last segment, up 8%. Okay, so sales by region. The company derives 35% of its sales from the US, or the Americas, I will say, including all that area. EMEA, 29%, Germany, 18%, Asia Pacific, 18%.
Lanxess could actually be a tariff beneficiary. When everyone thinks about the inflationary aspects of tariffs, they seem mostly focused on how much higher import prices will be passed on to consumers. There's relatively little discussion about the inflationary impact from domestic manufacturers raising prices. Almost 30% of Lanxess's manufacturing capacity is in the United States. In some areas, such as parts of its advanced industrial intermediates business unit, Lanxess is the sole remaining US producer and faces Chinese competition. The Chinese tariffs create a pricing umbrella where Lanxess can either raise price or gain share, or both. Further, some of the European manufactured products, including agrochemical precursors, have no alternative to US domestic supplier, and Lanxess also competes in the US with Chinese imports, which may be tariffed at a higher rate. There are several other tailwinds that should help improve Lanxess's bottom line over the next few years. First, the inventory destocking cycle is nearly done, and end users will start to increase purchases, leading to improved capacity utilization. Second, Germany just passed a significant infrastructure stimulus package of 500 billion euros over the next 10 years. All things being equal, it should increase Lanxess's baseline volumes by about 6% in 2026, and more than that in 2027 and 2028. Third, a number of end markets, particularly agriculture and European construction, are operating at cyclically trough levels. And finally, if Russia and Ukraine agree to a peace deal, there will be significant reconstruction that should be a tailwind for a lot of European industrial demand.
Now, Einhorn has spoke a lot about its debt reduction and how the company is becoming less levered.
Leverage has come down since, and Lanxess is using the proceeds from the sale of its urethane system business to further delever. Pro forma net debt should be down to 2.1 billion euros, and pro forma net debt to EBITDA will drop to a more normal 3 times by the end of this year. Management is committed to reducing the leverage ratio to below 2 times long term.
Now, what's interesting is the average interest rate of its financial liabilities is around 1%, which is pretty amazing given the current interest rate environment.
A 6 multiple on the 900 million of euros in 2028 would be worth around 50 euros per share at the end of 2027. If the market re-rated Lanxess to be a higher quality specialty chemicals company with a 7 or 8 times EBITDA multiple, which is also still a discount to where peers like Akzo Nobel and Croda trade, it would imply a share price between 60 and 71 euros. Alternatively, if Lanxess decided to repurchase shares when it gets to 3 times debt to EBITDA before the Envalior sale and at 2 times debt to EBITDA after the sale, the company could buy back a lot of stock. At the same EBITDA multiple, we would estimate buybacks could add another 15 euro per share of value. This assumes the stock price goes up 20% per year. Obviously, if the stock went up faster, the buyback would have a smaller impact. We could live with that. It is a compelling story. But wait, there's more. In 2023, Lanxess contributed its high-performance materials business into a joint venture with a private equity firm, Advent Partners. The joint venture was named Envalior, and it is a global leader in nylon and other engineering plastics. Lanxess retains a 41% stake, and it is a put option back to Advent starting next year. Next year, Lanxess has the right to put its remaining stake in the JV back to Advent at about 12 times trailing EBITDA. Lanxess chooses when to exercise the option, so it can select a time when EBITDA appears to have reached a cyclical peak. This is a very valuable option. Envalior is levered and has about 3.9 billion euros of debt. S&P Global Ratings has published a credit analysis that shows Envalior is expected to have between 475 and 525 million euros of EBITDA in 2026. We believe that this estimate is below the company's internal forecast. Assuming Envalior simply hits the midpoint of that estimate, Lanxess could sell its stake in early 2027 for about 860 million euros, which is over 1/3 of Lanxess's current market cap. If it appears that there will be further EBITDA growth, Lanxess might choose to defer a sale. Every 100 million of extra EBITDA is worth $500 million to Lanxess.
Let's just reiterate that point. The company could potentially sell its stake for 860 million euros, or close to 10 euros per share, which is over 1/3 of its current stock price. So that means a significant value of the company is in this stake, but even its raw valuation is also cheap.
Lanxess's goal is now to maximize the performance of the existing businesses. For 2025, Lanxess is guiding to 600 to 650 million euros of EBITDA pre-exceptionals, which is about 10% higher organically than 2024, given the divestiture of the urethane business. Lanxess will also complete its ERP system implementation and cost-cutting plans this year. The strategy appears to be de-risked.
Okay, so what are your thoughts? Do you think David Einhorn is onto something? Should we as investors be following these contrarian value investors, or should we stick with momentum, growth, crypto, and these more speculative assets? I'd love to hear your thoughts, so feel free to comment below. If you did find value in this video, feel free to join the community by hitting the subscribe button and of course the thumbs up, and let me know what you want to see more of, and I'll see you guys in the next video.